Welcome to our series on tax planning. I know how you feel. I used to feel the same way when discussing this topic, only because I knew at the end of the day it only meant how much taxes do I have to pay. Well, in this series I will discuss the different types of income so that you can start earning the tax-preferred kind and hopefully permanently eliminate the taxes you pay. Before we begin, I want to make sure everybody is aware that I am not an accountant or a CPA, nor do I even work in that field. What I will share with you are some nuggets that I've discovered from my research, experiences, and conversations I've had with our CPA that has helped us structure ourselves correctly in order to allow us to permanently eliminate taxes. But my advice to you is to consult with a CPA or your accountant to make sure these principles fit within your overall strategy plan and that they are correctly applied in order to make sure you achieve the results you're hoping for. Before we dive into the details of understanding how to permanently eliminate taxes, let's first talk about the different types of income. Don't get me wrong, some income is better than no income, but some types of income have more benefits than others. So it's important to understand each type in order to earn the right kind to help keep those taxes as low as possible. The first type of income that exists is earned income. This is income that is earned as an employee by self-employed individuals or partners. This is the worst kind of income you can have. Why? Let's not forget who is administering the paying of income tax, the government. So if you're not helping any of their causes, well then you will not be getting any benefits. So you'll pay high income tax and high employment tax, whether that's paid by you or your employer. The next type of income is ordinary income. This is income earned from pension plans, 401ks, and pensions. The only benefit this category has is that there is no employment tax, but you will still be taxed at the highest levels. Now, we're starting to get into the classification that is taxed at lower levels. It's the investment income. This is income earned from capital gains, interest, dividends, passive income from businesses and real estate. In this range of income, you can have capital losses that offset capital gains, which will save you on having to pay taxes on that income. You can also use expenses on investment loans to reduce the amount you are taxed on. But you are still taxed at a lower level, yes, but still have taxes to pay. Dividends are taxed at the capital gains rate in the US. You can earn some tax-free interest if you invest in state and local bonds, or you get life insurance proceeds. For those of you who are familiar with 1031 exchanges, that can also be done when dealing with stocks. However, you can only do that if you own most of the stock in a company. Our next type is gifts or inheritance income. The taxes in this class are paid by the estate, and if they have done some good planning, can be tax-free. And finally, we have passive income. This is income from business or real estate you don't personally manage. You are still taxed at regular rates, but there are many ways to reduce your taxable amount. If you have losses from passive investments in business or real estate, that can only offset income from a similar investment type. I mentioned the different tax rates briefly above, but only said you'd pay higher or lower taxes. So how much taxes is that exactly? Well, here's a table that shows you the different personal rates. As you've no doubt noticed, the types of income that allow for lower taxes and more incentives is when you do things that help the government promote their policies, like owning a business that creates jobs, or better still, owning real estate that provides affordable housing. Taxes are designed to encourage certain behavior by policymakers. I see it as government incentives and economic stimulus to keep the economy rolling. Taxes are a great way to earn more by doing what the government needs done. Taxes are our largest single expense. The average person pays 30 to 50% of income in taxes, from income tax, sales tax, value-add tax, employment tax, property tax, import tax, estate tax, gift tax, capital gains tax, tax on dividends earned, tax on interest earned, and I'm sure there are a lot more. The average person in a developed country spends 25 to 35% of their life working to pay taxes. There is also an increase in the number of entitlement programs that is creating a higher demand for tax revenues to support them. In the United States alone, there are $80 trillion of unfunded social programs such as Medicare and Social Security, and that number is growing. But do we have a choice? There are millions out there that legally pay very little or no tax at all. They understand that the tax laws is a tool used to shape the economy and promote social, agricultural, and energy policies. 95% of the tax code is intended to stimulate these policies. So it's like a roadmap that shows us not only how to reduce our taxes, but also shows us how to amass huge amounts of cash flow and wealth. The United States tax code is 16,845 pages long, and only a fraction of it is devoted to raising taxes. So it only makes sense to include tax planning when you're in your wealth planning. Here is an example of how taxation can affect your wealth. $10,000 grows to just over $60,000 in 30 years when taxed at 10%, but will grow to over $198,000 when taxed at 0%. We also have to look at all implications when making any investment. What would you consider a better investment? $100,000 in a 7% return in a real estate transaction, or investing that same amount at 10% return in the stock market? The 10% return from the stock market is before taxes, and stock market gains are capital gains, so they are taxed at 20% for a total return of $8,000. The real estate transaction returns $7,000 before taxes, and with depreciation, we were able to shelter it completely from taxes. The total amount of depreciation in this instance was $20,000, so we were able to apply the remaining $12,000 to another income to reduce taxes. So if you're in a 30% tax bracket, that amounts to an additional $6,000 in savings. So as you can see, we see investing as not just buying a piece of property. We keep up with the great incentives that are given to real estate investors to try and keep the income we earn to 0. So stay with me during the series, and I'll show you not only how we are able to structure ourselves to pay no taxes and on the income we earn in our real estate holdings, but also show you some other strategies that apply to some other types of income that you might be earning or thinking of earning in the future. If you would like more information or would like to see how you can start partnering with us to earn some tax-free income, drop us a line. We want to hear from you. Our contact information, along with more details and some great educational material, can be found on our website at www.simpleacquisitions.com. Now is a great time to invest in real estate. Don't delay in making your money work harder for you. Remember, real estate doesn't have to be complicated. With Simple Acquisitions, it's smart, secured, and simple. I'd like to thank you all for joining me today, and I hope you'll join me next time.